Welcome to The Explainer. Today, we are going to pop the hood on a pretty sophisticated investment strategy that's been getting a lot of buzz, direct indexing. We're going to break down exactly what it is, who it's really for, and the crucial trade-offs you absolutely have to understand.
So let me just start with a question for you. What if you could take a regular old index fund, say one that tracks the S&P 500, but you could personalize it and, at the same time, maybe even lower your tax bill? Well, that, in a nutshell, is the big promise behind direct indexing.
All right, first things first, let's get that 30,000-foot view. When people talk about direct indexing, what are we actually talking about?
At its core, the idea is actually pretty simple. Instead of buying a single share of an ETF that holds 500 stocks, you own tiny little pieces of all 500 of those companies yourself, directly. So think of it like this. You're not buying the prepackaged meal, you're actually buying all the individual ingredients. And it's that direct ownership that unlocks everything we're about to talk about.
But, as they say on the street, there's no such thing as a free lunch. Every single strategy has its pluses and minuses, and direct indexing is definitely no exception. So a SWOT analysis is probably the best way to lay it all out on the table.
And what this really shows us is the core tension here. On one hand, the strengths are really compelling. You get this powerful tool called tax loss harvesting, and you get total control to customize your portfolio. Screen out companies you don't want to own. But those strengths come with some real weaknesses. It's way more complex than just buying an ETF. The fees are higher, and at least historically, the investment minimums were huge.
Okay, so that big strength, tax loss harvesting, it leads to this thing the pros call tax alpha. And that's just a fancy term for the extra return you can potentially generate by cutting down your tax bill. But what does that really mean for your wallet? Let's try and put some real numbers on it.
I mean, this is the main question for any investor, right? Because you own all those individual stocks. You can sell off specific ones that are down to create a tax loss, and that loss can then cancel out taxes you might owe on other gains. So what's this benefit, this so-called tax alpha? What's it actually worth?
Okay, check out this table. It really lays out the potential payoff, estimating the tax savings over a 10-year period. Let's just follow the line for a $500,000 portfolio. You can see that in just an average market, this could mean an extra $40,000 in your pocket, just from tax savings. Now, look what happens if the market gets really volatile. That benefit could jump to 60 grand. It just goes to show how much market conditions can really supercharge this thing.
Now, this is where a really sharp investor needs to pay close attention, because those tax benefits, they sound amazing, but they are not some magic wand that works forever. The strategy has a very distinct life cycle.
And this quote right here, it really nails it. You have to think about direct indexing as a tool with a kind of expiration date on its biggest benefit. Why? Because that main advantage, the tax loss harvesting, is heavily front-loaded. Its effectiveness fades over time.
And this table here, it shows you exactly why that is. The key takeaway is right there at the top. Most of the tax losses get harvested in the first 5 to 7 years. After that, since stocks generally trend up over time, you run out of losing stocks to sell. So an older direct indexing account starts to behave just like a regular old index fund, with its most powerful tax benefit mostly used up.
So what this means is you need to think about this strategy as having a life cycle, a game plan, if you will. The play is to harvest those tax losses like crazy in the early years. Then after that peak period is over, the strategy totally shifts. You let your winners run, let those long-term gains compound, and you defer paying taxes for as long as you possibly can.
All right, so let's get to the final piece of this puzzle. Where does direct indexing fit in today's market? I mean, who is it actually for, and what's it going to cost you?
For the longest time, the answer was really simple. It was a tool for the wealthy, period. Because it's so complex to manage hundreds of individual stocks, the minimum investment was often $250,000, sometimes more. That put it way out of reach for most everyday investors.
But then, technology completely changed the game. Things like automation and fractional shares have let some of the big firms just slash those minimums. We've seen the barrier to entry just plummet, in some cases, all the way down to $5,000. I mean, that is a huge shift.
So what does that all mean? Well, the landscape today is just totally different. All the big brokerage firms are in on this game. But look at the fees.
typically 0.2 to 0.4%. That's still higher than a dirt cheap ETF. And that brings us to the most important point. With direct indexing, you are not paying for low fees. You are paying for potentially higher after-tax returns and that deep customization. The strategy has officially gone from Wall Street to Main Street.
So, at the end of the day, we've seen direct indexing is a seriously powerful tool. It gives you a level of personalization and tax management that a standard ETF just can't touch. But it comes with higher fees and more complexity, and its biggest benefits have a shelf life. It's not an exclusive members-only strategy anymore, but it is a very strategic one. And the ultimate question this explainer leaves you with is this: does its unique trade-off, its very specific set of pros and cons, fit into your long-term financial plan?